Hello and welcome to New Economic Thinking. I'm here today with Walker Todd, who is a trustee at the American Institute for Economic Research. Walker was also a member of the Cleveland Fed and worked at the New York Fed for about 11 years, I believe.
That is right.
So you have a good perspective in regards to economic or financial reform that has a chance of working. I want to ask you first, is it as simple as bringing back Nick Brady in one form or another?
It would help, but that is sort of like cutting the Gordian knot, the tangle of what to do about some of the terrible pickles that international finance is in these days. And bringing back Nick Brady would go a long way to solving the problem. Brady was the Treasury Secretary under George Bush I.
And of course, the thing that he did, in a sense, was bring pricing transparency to the debt problem, but also help to resolve it through a comprehensive debt restructuring program, which still seems to be steadfastly resisted by most parties in countries where there are chronic debt problems, such as Greece, for example.
Yes, that was his singular contribution to American international economic policy. Was in '89 he proposed a conference of bankers at which he told them that the administration, frankly, was sick of dealing with this dragging on debt issue regarding Latin America. And he proposed a debt restructuring under which the banks would agree to write down 35 to 45% of either the principal or the interest obligation that the countries owed, and it would be negotiated on a country-by-country basis. But in return, the U.S. government, via the Treasury, would put up bonds that the debtor countries would purchase. They were 30 to 40-year bonds at zero coupon, with the idea that at maturity, the bonds would be worth the amount of principal that was to be owed, so that in that way a country would essentially be given 30 to 40 years to pay off the accumulated debt to the banks.
Now, of course, one of the arguments against a Brady Plan that one hears today is that in the old days, the banks held this debt on their books, so that you could use a hold-to-maturity type of accounting arrangement, and also even in terms of restructuring, it was much easier to manage. But nowadays, you've got a lot of sliced and diced credit securitized, and it's a much more complicated factor. That might apply in the U.S. with regard to the mortgage mess. I'm not sure it does, but maybe you could make that argument. I'm not sure it applies as much in Europe, for example.
Regarding the current European situation with the southern periphery countries and the debt position they have regarding some of the northern creditor countries, I agree with you that to the extent it's been securitized out, it is a much more difficult problem to deal with. You would wind up having to rely on the law of each country involved to require debt holders in each country to abide by the terms of any such agreement. And that might be difficult under the laws of various countries. But as long as the banks hold the debt, you should be able to do something, I believe.
And I believe you maybe only half-jokingly at one point suggested that Nick Brady ought to be invited to this side of the Atlantic to discuss a Brady Plan Mark II in one form or another, maybe with regard to having due regard to the implications for Greece. How was this received when you suggested it?
Well, actually, I wasn't in contact with Mr. Brady at the time, but about 3 or 4 years ago, when the current situation began to emerge, Mr. Brady was interviewed by a reporter in New York who asked him would he be willing to go to Europe and offer his good offices to see if a deal could be made. And he expressed a willingness to do so, but no one would invite him. So that was the problem, that too many powerful people wanted him not to come to Europe.
Anything to avoid pricing transparency.
That is right.
I want to take a step back and go to a slightly broader perspective. A number of years ago, I think on your recommendation, I read a book by Mr. Jesse Jones,
Yes.
his 12 years at the Reconstruction Finance Corporation,
Yes.
$50 billion. It was a big sum of money in those days.
Yes.
But you spoke at a conference where you said that you had met with the members of the Swedish government and the Norwegian government when they had dealt with their own banking crisis in the early 90s. And they told you that this had been their playbook.
Yes.
Which I was very struck by, because it seems that we've collectively forgotten our history here in the U.S., at least as far as it came to resolving our banking problems.
Yes, I didn't actually contact them directly, but I figured out that something like getting Jesse Jones's book into their hands must have happened, given the exact structure of the banking resolutions that were pursued in Sweden in 1992-93 and in Japan in 1998-99, and inquired among friends who knew the economists involved. There were Bo Lundgren in Sweden and Richard Koo in Japan. And sure enough, I had given the book to a friend in New York, who in turn had given it to each of them as they in turn were visiting him in New York. And so via that method, Jesse Jones's book made its way back to both Sweden and Japan, where it was studied carefully by the authorities, and they used its recommendations for how to restructure the banking system.
And for the benefit of the 12 of us who have read the book, but maybe
Right.
for the several 100,000 who haven't read it but should read it, why don't you just go over the broader policy solutions that were outlined in the book?
Yeah, the basic situation that Jesse Jones and the Reconstruction Finance Corporation faced in March of 1933 in the depths of the Great Depression was that suddenly all of America's banks were closed, and they remained closed for about a week. During that time, people were not idle at the Federal Reserve or the Treasury. Essentially, every bank examiner in the United States was rounded up and sent into the banks to examine as many of them as they could simultaneously. And at the end of a week, the authorities in Washington had a pretty good idea of which banks were solvent, which were barely solvent, and which were somewhat insolvent or had to be let go. And so Jones said that they classified all the banks into groups of A, B, and C banks. A banks were those deemed solvent, and they were licensed by the Treasury Secretary to reopen as soon as they received the appropriate license from him. The B banks had lost most of their capital, but with a little bit of Treasury assistance, they would be able to reopen and serve their customers also. The C banks were those that were not allowed to reopen until they had either replaced lost capital or they would be put in the channels of liquidation. And as it turned out, there were something like 17,000 banks going into the crisis. Only 12,000 emerged in Class A or B. And a reporter asked former President Herbert Hoover what had happened there. Why had they lost 5,000 banks in the process? And Hoover's response was, well, you see, there were 17,000 banks, but there were only 12,000 competent bankers.
And of course, there was another interesting codicil to that story, which was, I believe, that Jones asked for, he got each of the bank executives to submit letters of resignation to him, which he then stored it in his safe or to take out at a time of his convenience. He didn't do that very often, I don't think, but at least he had that option available to him.
Right. For all the banks that were receiving assistance from the RFC, he would routinely ask the management, the top three officers, to give him letters of recommendation.
Resignation,
rather, so that he would then, in most cases, not act on them. But as he put it, I think you will behave more prudently going forward, knowing that I have these letters. And in some cases, he did remove management. This is comparing what happened then versus what happened in the period of the TARP program in the United States in the aftermath of the fall of 2008.
When in fact the Geithner Treasury did, and the Paulson Treasury did everything they could to destigmatize the receipt of money, and certainly did
Yes.
not go as far as punishing management for making those mistakes that got us into the mess.
This is correct. My recollection is that only one chief executive of a big bank was required to resign, and that was Kenneth Lewis at the Bank of America. And also, because General Motors received money under the TARP program, the Treasury later required the CEO of General Motors to resign. But those were the only two.
And of course, as Bill Black, amongst others, has pointed out, nobody has gone to jail over this period in regard to for any fraud or crimes committed. Even those banks which were engaged in explicitly documented criminal activity.
This is correct, and regrettably, the statute of limitations has either expired or is fast running out on nearly anything that could be charged properly during that period, because remember, that was in the fall of 2008, and we're already about 6.5 years beyond that point, and most of the relevant crimes would have either 2-year or 6-year statutes of limitation.
Okay, so well, avoiding the what Tim Geithner might call this Old Testament resort to justice, let's look at the broader question of reform today, which you think would have a chance of succeeding, which would be effective, and which would help alleviate the problems we're still experiencing. What do you think these would be, or are there any, for example?
Well, there are several. I mean, by and large, one of the things that was accomplished when Jesse Jones restructured American banking in 1933 was that there were no large bank failures for the next 40 years in the United States. And given recent history, you might say, well, that's remarkable, it's miraculous. But no, it was a rational consequence of the restructuring that was done. Basically, Jones said, you will behave prudently going forward. At all the banks that were assisted, you basically did not get to retain your job unless you had his approval at the higher levels. And he was generally considered a sober and prudent businessman who did not willingly risk the government's money on losing propositions. Today, you might recommend going back to traditional banking, at least for the insured bank activities within the United States banking system.
Wasn't that one of the objectives of the so-called the Volcker Rule? Was it?
Yeah, the Volcker Rule would have gone a long way toward getting back to traditional practices. It was a somewhat watered-down version of the GlassSteagall Act, which was implemented about the same time that Jesse Jones took over the RFC in the 30s. The Glass-Steagall Act basically separated commercial banking from investment banking. And this was repealed effectively in 1999, and it was probably a bad idea.
That was Graham-Leach-Bliley.
Graham-Leach-Bliley Act, yes.
One of the of course, with the repeal of bank holding companies and Glass-Steagall, rather, you're in a situation, a lot of people say, where the older types of reforms can't apply anymore. One of the other issues being that you've got a large amount of credit intermediation that goes on via the securitized market. So the argument is that you can't really apply the remedies of the 1930s when you had a very different structured banking system. What's your response to that argument?
And the answer came up in discussion in both yesterday's panels and some of the panels today at this conference, where the idea is perhaps the so-called skin in the game requirement should be raised so that banks would be persuaded not to securitize everything, to hang on to a much greater proportion of the risk in the loans that they put on the books, instead of selling off all the risk to other parties through securitization. And that if you either outlawed securitization for most forms of lending or raised the skin in the game requirement to, say, 25%, that this might open the path toward bringing back the older forms of regulation.
And also there has been some talk of trying to restore some sort of quasi-partnership structures, which effectively
Yes.
would leave the investment bankers in the position of having skin in the game, because if they didn't, of course, their institution could be taken down by their actions.
Yes. For that one, for example, you could require something like the top 5 or top 10 officers in the investment banking side of a bank holding company to essentially be personally liable, personally at risk for losses of the firm. Alternatively, you could require them to be liable within limits, but up to a decent multiple of the shareholdings or their salary or some combination thereof. In the 1930s, the legacy that Jones inherited was that bank stockholders were liable for an additional amount equal to the par value of the stock that they held. And typically the bank par value stock then was $10 a share, and that was a lot of money in the 1930s. So as it turns out, depositors by and large received back their money in full. But because of this so-called double call or double liability provision for bank shareholders, if you heard tales that grandpa went bust in the 30s when he lost all his money in the bank, it was because he was a shareholder, not because his deposits were not returned.
So this would be another way of preserving the skin in the game. Of course, all of the recent activity by governments, particularly in the U.S., have gone in the opposite direction. They seem to be gutting whatever limited reforms were carried out in Dodd-Frank, the most recent being the government continuing resolution that was passed at the end of last year, which
Right.
was supposed to just be there designed to keep the government funded for a certain period of time. But of course, under that cover, there was a provision slipped in to effect gut the provisions of the recommendations of the Volcker Rule, whereby taxpayers' money would not be committed towards speculative activities. That's effectively gone right now.
Yes, it's been watered down a great deal, and also as part of a recent budget bill that passed on a must-pass basis, of course. At the last minute, lobbyists for a certain large New York financial institution persuaded a congressman from suburban Kansas City to introduce a measure repealing the Lincoln Amendment of Dodd-Frank. The Lincoln Amendment was a requirement that credit default swap activities and index-linked derivatives should be pushed out of the insured bank and should be engaged in. These activities could only be engaged in under bankruptcy vulnerable subsidiaries of the holding company. And unfortunately, this amendment in the recent budget bill repealed the Lincoln Amendment. So therefore, the banks can, once again, engage in credit default swap activity and index-linked derivatives activity inside the insured bank, thereby conveying to other market participants the implication that the U.S. government financial structure stands behind your right to claim payment of this debt.
So has there, in fact, been any real substantial reforms that have changed banking activity fundamentally, or are we almost back to where we were in 2006, 2007? Granted, we don't have as much leverage, but I suspect that's partly a function of people still being risk averse after almost going under in 2008, as opposed to any legislative or regulatory changes that have been made.
Right. I think we are better off, but only halfway at most toward the goal of a reasonable and sustainable reform of banking supervision. To the extent that risk-weighted asset measures as a measure of capital adequacy are retained as a primary objective, essentially folding Basel III requirements into U.S. bank supervisory procedures. I think most reasonable reformers think that this is not the way to go, because the minute you admit risk weighting of assets in the capital structure, you allow for political bargaining to take place
Which is
with
effectively
the
what happened with
regulators.
Basel II. I think that's exactly
And
what
that
happened.
is what undermined Basel II, that is right. And so that forces as diverse as Governor Tarullo of the Federal Reserve Board, who most of the time in recent years has carried the ball for bank supervision matters, and Ed Kane, a professor whom I think you interviewed a year ago and who's also at this conference, and other scholars generally agree. Also, Thomas Honig, the vice chairman of the Federal Deposit Insurance Corporation and the former president of the Kansas City Fed, and he's a former bank examiner himself. They all agree that probably it's best just to go with straight leveraging requirements and ignore all this risk-weighted asset stuff in determining capital adequacy going forward.
And what's the likely prognosis of that occurring? Is it likely to occur or not?
I'm afraid that the political winds in Washington are such that Basel III and risk-weighted asset measures are probably still with us and will be very hard to get rid of.
So we let, to paraphrase Rahm Emanuel, we did let a good crisis go to waste. We might need another one to get genuine financial reform that has a chance of working effectively.
Yes, that is a subject that's been discussed both a little bit at the podium and very much in the corridors at this conference, where the question is twofold. How likely are we to have another financial crisis? And when it comes, is it likely to be as bad as the last one? And I think the consensus is yes, another one is likely, thanks to the watering down of the hoped for supervisory reforms. And in part because of that, and in part because of the ongoing condition of finance generally, both in Europe and the United States, and increasingly in emerging market economies, this creates a problem. I think it will come probably within 5 years, possibly much sooner than that. And it will be about as bad as the last one, if not worse, in part because the Federal Reserve, for example, has already used up all of its ammunition. It bloated the balance sheet by a factor of 5 since the beginning of the crisis.
And it doesn't have the same kind of political credibility as well. So
correct. They have much less credibility now. So the question is, how far can they go in relieving the next crisis?
Well, on that somewhat a disconcerting note, I'm going to have to end it here. But Walker, Todd, as always, it's great to speak to you. And thank you very much for sharing your insights with us.
Yes, thank you.